Okay, for those of you that are joining us, we will start in just a minute. Just going to give it a little more time to get some more attendees the opportunity to join in. Okay, well, thank you all for joining us this afternoon. We're very excited for this topic and to share this with our fellow nonprofits out there. I'm going to begin by introducing our two speakers, and then Jackie will begin with her portion of the presentation. So today we have with us Chris Anderson. He's a shareholder with Maloney Novotny. He joined the firm in 1994 and has been a shareholder since 2009. He brings deep expertise in taxation and consulting for both tax-exempt and taxable entities. With over 30 years of experience, he specializes in nonprofit tax matters, including tax-exempt compliance, unrelated business income tax, and restructuring tax-exempt groups. He has conducted numerous mock IRS audits for exempt organizations. As a chair of the AICPA's Taxation of Exempt Organizations panel, Chris plays a key role in shaping tax policy, engaging with the IRS and Treasury on complex compliance issues. He also serves on the planning committee for the AICPA's National Nonprofit Industry Conference. Beyond the nonprofit sector, Chris advises closely held businesses and high net worth individuals, leveraging his vast tax knowledge to navigate IRS and state audits. A CPA since 1993, he holds a business administration degree from the University of Notre Dame and is a sought-after speaker on tax-exempt issues. Thank you, Chris, for joining us. Our other speaker is Jackie McLaughlin. She has been with Chazen & Company for a number of years. She's a CPA with over 35 years of accounting experience, including 18 years dedicated to nonprofit organizations. Starting her career at KPMG, auditing tech startups, she advanced to audit leadership roles in Fortune 500 companies before transitioning to nonprofit financial management. At Chazen, Jackie oversees technical reviews, training, and financial reviews, ensuring nonprofits meet the highest standards of fiscal responsibility. An accomplished educator, Jackie spent 10 years as a top-rated instructor for the nation's largest CPA review provider and has taught financial tools and strategies to small business owners and CPAs. Her sessions empower association professionals to innovate, lead with confidence, and drive positive change through strong financial foundations. Thank you, Jackie. One quick housekeeping note, if you would please enter all of your questions in the box that has the question mark, that will help us keep them all in one place. And I will address your questions throughout the presentation, so please feel free to enter them as they come to mind. With that being said, I will hand it off to you, Jackie. Thank you.
Thanks, Karen. And thank you everyone for being here. So today I'm going to kick us off and talk a little bit about things that nonprofit leaders need to know with respect to their leadership roles and their responsibilities. And that's going to lead to a natural segue to Chris, who's going to talk more about the 990 tax return that nonprofits are most nonprofits, and he'll get into that, are required to file. So that said, let's get going. So the agenda for my part today is we're going to talk about fiduciary responsibilities, budgets, financial statements, and then the external parties that nonprofits have to deal with. And that will be the nice segue to Chris. Chris and his firm is one of those external parties that nonprofit leaders need to work with. So first, we're going to work on understanding your fiduciary responsibilities. So these are two words that many of us hear a lot in commercials and things like that. We always hear about our fiduciary responsibility. And I would also guess to say that most people don't really know what fiduciary responsibility really means. So this slide is all the legal jargon behind fiduciary responsibility, and it essentially says that nonprofit leaders are fiduciaries who steer the organization towards a sustainable future by adopting sound ethical and legal governance and financial management policies, as well as by making sure the nonprofit has adequate resources to advance its mission. Now, if most of you are confused, the way I certainly was when I read all this legal jargon, let me read one more slide of legal jargon, and then we're going to interpret that for you. So as a nonprofit leader, you have three primary duties: duty of care, duty of loyalty, and duty of obedience. If you start with duty of care, it means you have to make prudent use of the organization's assets. And what we mean by assets is, yes, cash investments, yes, but also the time resources that the nonprofit staff will put into achieving the mission. As a nonprofit leader, you also need to exercise oversight to ensure effectiveness and sustainability. So notice they use the word oversight, particularly if you're a board member. You're not somebody who's going to get down into those operational weeds. That's for the staff to do. But as a board member, you're going to be that person who kind of pulls out of the weeds and sometimes can see things a little bit more clearly than people can who really are working down in the details. And you're going to act with a greater degree of care than you might give your own affairs. Duty of loyalty means you're going to make decisions in the best interest of the organization without any regard to your personal interest. And duty of obedience means that you'll help ensure that your organization is following its bylaws and, of course, complying with any laws and regulations, which again, later on, some of those regulations are things Chris will talk about with respect to the 990. So that's all the legal stuff behind fiduciary responsibility. And here's what it is. It's no different than parenting. So when you're a parent, if you look at all these three duties, when you're a parent, you have to make prudent use of your household's assets. You are budgeting out your time and your personal finances so that you can adequately clothe your children, feed your children, provide a roof over their head, and just as importantly, spend time with them, parenting them. Looking at duty of loyalty, when you're a parent, you make decisions in your children's best interest. Many of us have been in a situation where we have a really incredible opportunity in our career, maybe across the country or maybe in another state. We don't automatically say yes to that. We think about our children and how this is going to impact our children. And in the end, we make a decision that first and foremost is in the best interest of our children. And then secondarily, sometimes it might be in our best interest as well. Sometimes it won't, because we're deferring to the best interest of our children. And finally, the duty of obedience. As parents, we always teach our children, obey the law. And we not only talk about that, but we demonstrate it. We obey the law, except for those occasional instances where we all speed. But other than all of us, I'm sure there's nobody on this call who hasn't done a little speeding here and there. But other than that, we demonstrate to our children every single day that you need to withhold the laws of the country and the state and the city that you're living in. So that's fiduciary responsibility. As a nonprofit leader, you are the parent to this nonprofit organization that you're involved with. The fiduciary duty comes with some liabilities. So the first thing we learn on this slide is that there is a risk. You can be held liable for damages caused by your wrongful is the key word, acts or omissions. So going back to the previous slide, duty of obedience, just don't lie. Don't lie when you're talking about your nonprofit. and you can help protect yourself from this liability of having the risk. One of the defenses for the liability that you have as a nonprofit leader is to understand your responsibility, and then, of course, to ensure that your organization follows its laws and bylaws. And finally, your organization can carry some directors and officers insurance that will help if help is ever needed. Many nonprofits think that directors and officers insurance, also called D&O, is very expensive, and they believe it to be unaffordable. It is not necessarily that way. So if your organization does not carry D&O, I encourage you to at least call an insurance professional and get some quotes on that. So some of the things you can do to reduce your personal risk is to be familiar with the nonprofit financial statements. And we're going to talk about that in a couple of slides, but we're not going to talk about that using accounting words. We're going to talk about it using words that non-accountants can understand. You should also understand the internal controls in your organization, and we'll talk about that. As a nonprofit leader, you have to set the proper tone at the top. So what does proper tone at the top mean? Again, if you're a parent, you are living with integrity every day, you're following the laws, you're living with compassion and empathy. These are characteristics that you are demonstrating for your children. As a nonprofit leader, you need to act with integrity, follow the law, display the best ethics or the highest ethics that you can, because you're setting the tone for the organization. And then finally, ensure, which really goes up there with you and the understand, that no single person has too much power or control over financial transactions. You want to diversify the hands that touch anything financially oriented, if you can. And if you can't, there are some mitigating controls that can be put around that. There's a couple of policies that do support the tone at the top. Chris may touch on this a little bit because certainly the 990 form asks if you have a conflict of interest and a whistleblower policy. Now, I kind of slid in there a gift acceptance, which isn't really necessarily tone at the top, but it's a good idea to have a gift acceptance policy. But conflict of interest is when board members or nonprofit leaders act in their own interest and not the organization's interest. So I'm going to give you two examples of that. A good example, well, I'm going to start with a bad example, and then I'll end with a good example. So a bad example was from my career previous to coming to Chazen & Company, and I worked for a nonprofit organization, and one of the board members was a financial planner. And he came into my office one day and he threw a bunch of papers on my desk in a very threatening, aggressive way. And he told me that he was shifting the way that the organization was investing its assets, and I needed to sign these papers and make it happen. And Chris is looking shocked there because, first of all, I didn't have that authority. You need to run those decisions through the investment committee, which I told him, and he didn't like my answer. So multiple times a week for at least a month, he would come in and try and bully me into signing these papers. And I kept saying, no, you need to go to the investment committee and do this the proper way. Ultimately, he had no choice but to do that. And in fact, it was a bad investment, which is not my words, it's the investment committee's words, because they refused to authorize the signing of these papers to move the investments over. That is a bad example of conflict of interest. A good example of conflict of interest was another organization where the chairman of the board had commercial property, and some of that property was parking lots in an urban area, parking spaces. The nonprofit that he was chairman of the board on needed to rent some parking spaces for their staff and their stakeholders, and he submitted a proposal to the organization for a monthly rent amount. The staff in the organization went out and sought competing bids, and then at the next board meeting, the chairman's bid was was proposed to the whole board, as were the competing bids. And then the chairman of the board recused himself from the meeting, and the rest of the board took a vote. Epilogue: his bid was competitive with all of his competitors, and so the organization did decide to go with his commercial development company, and he rented them the parking spaces. The point is that yes, he did get business out of the organization, and that was okay because of the way he handled it. Competitive bids, board decisions at a meeting that he recused himself from. So that's a good example of upholding the conflict of interest policy. Secondly, it's nice to have a whistleblower policy. We've heard a lot about whistleblowers in the last, 20 years. So a good whistleblower policy might be a phone number that employees could call, or an email that they could email that would keep them anonymous, where they can report any potential wrongdoing. Quick side note, auditors are not in the business, and I'm going to let Chris chime in here to confirm what I say or deny what I say. Auditors are not in the business to find fraud. When they're doing audits, if, as I like to say, if on the way to the audit they discover fraud, they will report it, and they have an obligation to report it. But an audit is not designed to catch fraud. And Chris is nodding, so he...
Exactly right. Even though I'm not an auditor, I have heard that many, many times from my audit colleagues.
Yeah, not designed to find fraud. And statistics show if fraud is being committed because of collusion between two or more people, or management override of controls, auditors will not find fraud. Statistically, the most common way that fraud is found is through a whistleblower. So these whistleblower policies can be very important. So part of your fiduciary responsibility is understanding your organization's financial statements. And as a nonprofit leader or a board member, you're going to review the annual budget every year, or hopefully you're reviewing an annual budget every year to approve it or send it back to the drawing board. Most people hate budgets. I don't know anybody who loves doing a budget. They hate them. They view them as restrictive. I want to offer an alternative to that thought process. Budgets are nothing more than your guideposts to the year ahead. If you're going to drive from New York to California, you need a map or a GPS with the coordinates programmed in. You need one of those things to get you there. Otherwise, you're just going west and you don't know where you'll end up. A budget does that for your organization. So, for example, most organizations have a 5-year strategic plan. It's called 5 years for a reason. You can't do it all in 1 year. So usually you'll choose one piece of that 5-year strategic plan every single year. You'll choose one piece of it that you're going to execute that year. The way you make sure you execute it is you budget for it. You put it in your budget. If you spend some time proactively up front doing a budget, it will be your best friend, believe it or not. And nonprofit leaders, I love this little angle too, it can help with decision fatigue, because when your staff comes to you 25 times a day with 100 great ideas, which they will do, your response is it in the budget? If it is, go do it. If it's not, put it in next year's budget. We're not going to do it. So it can help with that decision fatigue as well. The other important piece to having a budget is to monitor your progress every month against the budget. So you have your budget, you have your actual results, and you've got to compare the two and figure out not only what's gone wrong when you've overspent your budget, but also what's gone right. What happened if you brought in more revenue in a month or a quarter than you budgeted for? What did you do right? You want to do more of what you did right. Oftentimes, I compare financial statements to LeBron James' basketball career, which I won't go into that right now, but one thing that LeBron does is after every game, he reviews his film from the previous game. and he reviews his film for things that he didn't do quite well, complete mistakes he made, but also things he did correct. He reviews it for all of those things. As a nonprofit leader, your version of LeBron's film from his last game is your budget to actual report.
Jackie, one quick question. Sorry to interrupt you. It has to do with your slide before budget, but it says, what if an accountant from the accounting firm for the nonprofit is also a board member?
I'm not quite sure I understand. Like, would that be a conflict of interest? I'm going to
Correct.
assume they mean
That's
would
what they're
that be
asking. Yeah.
a conflict of interest. So I think we could apply the same parking space rules to that example as we could to this particular question. So one, I'm presuming that an accountant for the nonprofit is being paid in either on W-2 or outsourced, and they're a board member. So actually, I'm going to go ahead and assume outsource. It would be very unusual for a W-2 employee to be a board member as well. So if this is an outsourced accountant, is there a conflict of interest if they're a board member? Not if the organization got competitive bids for that outsourced accounting, had a board meeting to discuss the board members' firm's price, the competitor's price, the board member recuses themselves from the vote, and the rest of the board takes a vote. And any other questions, Karen?
No, not at this time. And William, if for any reason that is not what you were looking for in an answer, if you'll just put it in that same area, I'll follow up. Thank you.
So we're going to touch somewhat quickly so Chris can talk about the 990 on financial statements. And you can see from this slide that nonprofits have very similar financial statements to for-profits. They're just named a little differently. So the balance sheet is named the statement of financial position. The P&L is named the statement of activities. So when I do these kinds of presentations to a group of people who aren't accountants, I just stick with balance sheet and P&L. Those are terms that people are more familiar with. So as we continue, I'm going to use balance sheet and P&L. So one of the things that nonprofit leaders and nonprofits need to be concerned about that differ from their for-profit counterparts is the revenue stream that comes into a nonprofit. So oftentimes nonprofits have a lot of funding from contributions from donors. Well, this is where nonprofits and for-profits divert a little bit, because if you have contributions from donors, the donors may put restrictions on those contributions. And restrictions look like this. I'm going to give you $1 million, but I want you to build a bell tower with this $1 million. So I'm telling you what to do with your money, which in nonprofit terms means I've put a restriction on it. And it is critically important that a nonprofit follow the donor's guidelines. If I give you money to build a bell tower, you cannot use it to keep the lights on in your administrative offices. You have to use it to build the bell tower. Donors can put two types of restrictions on contributions: permanent restrictions or temporary restrictions. Temporary restrictions are that bell tower. I'm giving you money to go build a bell tower. You can spend it, you just have to spend it on the bell tower. Permanent restrictions are a little different. So again, real life example, before coming to Chazen, I worked in a community with a symphony orchestra that was going bankrupt. The community had a Bill Gates level of wealth person in it. He loved the symphony. He didn't want them to go bankrupt. This was, well, I don't want to tell you how long ago because I date myself, but it was many, many years ago. He gave them $55 million and he said, you can't touch it at all. When I tell non-accountants that story, they look at me like I'm going out of my head. Are you crazy? What do you mean you can't touch the money? How can they sustain themselves if they can't touch that $55 million? Because what they can touch are the earnings on that $55 million. In this donor's particular example, he gave them 55 million and said, hey, the earnings, use it for what you want to use it for. Unrestricted. The earnings were unrestricted. The 55 million they could never touch. More often than not, donors will temporarily restrict that 55 million in my example. So here's 55 million, take the earnings and build a bell tower. So in that example, you've got the same pot of money, 55 million. Some of it's permanently restricted, don't ever touch it. Other pieces are temporarily restricted. Go build a bell tower with the earnings. And then you have without restrictions, which is when donors give you money that you can do whatever you want with. They don't put any restrictions on it. Boards can take some of that unrestricted money and designate it. And designated is what you and I think of in our personal life. We're earmarking this money for emergencies, or we're earmarking this money for the family vacation that's coming up that we want to take. Boards can earmark money too, but they can only earmark unrestricted money. And when they earmark it, it's called designated, board designated. Here's an example of a budget versus actual report, all made up numbers. You can see in the farthest left column, we've got the without donor restriction money, and then we've got with donor restriction money for the total compared to the budget, and there's the variance report. Now, somewhere in this variance report, there is, it's down toward the bottom, a $4,000 variance. With this level of numbers, you're probably not going to look into a $4,000 variance. But at the top, you've got a $2.6 million variance and a $3 million variance. And you'll definitely be wanting to dig into why you have that variance. So here is that statement of financial position, which you might think of as a balance sheet. You'll notice the biggest difference is down at the bottom. Nonprofits have net assets. They don't have an equity section. And those donor restrictions that we talked about that come in through contributions, those donor restrictions retain its classification down here in the net assets section. So I am going to go into the LeBron James story, as it seems. So financial statements are kind of like LeBron James. He's got career stats. So he's going to play a season. He's got season stats. He's going to play a season. He's going to rack up stats, how many points he put on the board, how many assists, how many free throws he made. That's all going to be in his season stats, and basketball fanatics monitor that and watch that very, very closely, as does LeBron. If LeBron has a bad game, doesn't mean he's going to have a bad season. If you have a bad month, doesn't mean you're going to have a bad year. But like LeBron, you have to do something to turn it around. If LeBron has a bad game, he's watching that film, he's taking action steps to have a better game next time. That's what you should be doing, is your P&L or your statement of activities is LeBron's season stats, how you're doing in that season, which is typically, we call it a year or a fiscal year in business. But LeBron's season stats are your fiscal year stats. And when you have a bad month, that doesn't mean you're going to have a bad year, but you got to watch your film, i.e. look at your budget to actual report and figure out what you did right, what you did wrong, and how you can course correct. The statement of financial position is like LeBron's career stats. So at the end of the season, LeBron's season stats zero out. They have to, so that he can start the next season all over again. But they don't just go away. They aggregate in with his career stats, and they change his career stats by the stats he had during the season that just ended. Your balance sheet or statement of financial position is similar to LeBron's career stats. So you can see at the bottom, net assets down at the very bottom. That is where LeBron's season stats, AKA your P&L, zero out. And when they zero out and they hit the career stats, they hit it down in the net asset section, and they retain the restriction classifications that they originally got in the P&L if you haven't used that money yet for the purpose intended. So if I give you $1 million to buy a bell tower, the end of the year, you haven't started to build the bell tower, that $1 million would close into the career stats here, the balance sheet, and still be restricted. If you had built the bell tower in the same year I gave you the money to do it, that money would no longer be restricted because you did with it what I intended for you to do with it, and it would close out along with the expenses related to building the bell tower. It would close out into this net asset section. And perfect timing to segue over to Chris. So one of the things that nonprofits have to do is file a 990. And as an aside, Chris is going to cover the 990, but your charitable solicitation license may require that you have an audit, and then you would deal with Chris's partners in crime on the audit side. So that said, take it away, Chris. Do you want me to stop sharing, Chris, or do you want
Yes,
to
please. And we'll see if we have technology working for us here.
In the interim, Jackie, I have a couple questions.
Mhm.
Does a 501c6 organization use the same terminology for financial statements?
Yes.
And I guess
And
that
we're
was it. Sorry.
having an issue. Here we go. So hopefully now everyone can see my screen, and it says up next. And so what we're going to delve into now is, as Jackie had mentioned, the 990 itself. And this is not meant to be a technical presentation. We are not going to get into the nitty-gritty of the nuances and the instructions or the Internal Revenue Code and its regulations, but instead we're going to look at it really from a reader's perspective and focus on those areas that a potential reader would actually want to look at and what kind of information they can glean from that from your 990. So if I can move the slide here, we live and die by technology, don't we? There we go. Okay, so let's start at a very high level first and talk about what the 990 is. And Jackie had alluded to this a little bit in her presentation. It's a tax return, really an informational return that many, but not all, tax-exempt organizations have to file annually. It is made up of a core form of 12 pages with 12 different sections and the possibility of attaching 16 different schedules. Thankfully, the most schedules I've ever had for a client's 990 is 13, and that's largely because some of the schedules are devoted to a particular activity or a particular item that only applies to those organizations that engage in that activity or item. So for example, there's a special schedule, Schedule E for schools, there's a schedule for hospitals with Schedule H, and there's a schedule for organizations who do things outside of the United States on Schedule F. So again, if you don't do any of those things, then you don't have to attach those schedules. Thankfully, for smaller organizations, many of them don't have to do the full 990, but instead have two other options available to them, the 990N or the e-postcard, which is if their average gross receipts are less than $50,000 per year. This is a very easy filing. It's on the IRS's website and essentially asks about the name and address of the contact person, telephone number, if the organization is still in existence, and if that organization is under 50,000 of gross receipts. That's it. No board members, no financial information, none of that. So I obviously encourage those clients that are small enough to go ahead and issue the 990N if they qualify. If they don't qualify for the 990, there's another option for, again, smaller organizations, and that would be the 990 EZ. And here there are two tests, and you have to meet both of them to do the 990 EZ. And that is that the gross receipts for the year are under 200,000, and total assets at the end of the year are under 500,000. This core form of the 1023 EZ has 4 pages to it, and there's a possibility of attaching 8 of the 16 schedules while the other 8 are off the table. So again, an organization, because of limited resources, limited time, limited expertise, should file the form that is appropriate to them. We're going to focus mainly on the 990, though, for the rest of the presentation. And one of the things that I wanted to briefly point out, especially since I said many but not all organizations are required to file a 990 that are tax exempt, here is a list of organizations that do not have to file a 990. Churches, church affiliated organizations, schools below the college level that are associated with churches. The big ones, state and local governmental entities, and those would include instrumentalities too, like libraries. State colleges and universities. So for example, after their big national championship win in football, you might want to look at the 990 for Ohio State University. But unfortunately, they don't file one, so there's nothing to see. Instead, if you're a private college or university, like Case Western Reserve University in Cleveland, that is a 990 that you can reach out and take a look at. Some other things like private foundations file a different form, the Form 990 PF, instead of the Form 990. And then retirement plans and foreign organizations, as you can see there, are also exempt from filing the 990. And what I like to tell clients and remind them of often is they should think of their 990 as their most important public relations document. And why is that? Well, the 990 is open to public inspection, so you are required, if you're a tax-exempt organization, to have your 990, again, if you're required to file, in your business office for a period of 3 years. So your most recent 3 years worth of 990s must be available for in-person inspection during normal business hours in your business office. In addition, there are third-party websites, as you probably know, like GuideStar and ProPublica, that are out there that post 990s themselves. So obviously, anyone with an internet connection can go to those websites and take a look at an organization's 990. Even the IRS is starting to post 990s on its own website, so you can access them there as well. Now, the difference there, obviously, between the 990 and materials generated by the organization directly are, for example, a printed report to the community, by its very nature, has a limited distribution by the number of people that get sent that and the number of copies that are printed. Also, an organization's website may be difficult to find, may be more difficult to find than going to GuideStar and finding the 990, or if we're being a little bit cynical, may not be deemed as trustworthy as the 990. So again, the 990 becomes that important public relations document, and all filers should ensure with their accountants and other outside advisors that their 990 is as accurate and complete as possible. And so keeping our focus on the reader, there are some areas of focus that I want to look at in specific sections of the 990, not in any particular order here, except for the very first one. And yes, it is redundant, but by saying compensation, 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 I think you get my point that that is the most important section of the 990. Other things that we're going to take a look at are program services, some financial information, some of what Jackie had touched on, some grants, government governance and other policies, foreign country kind of activities, and then areas scrutinized by sophisticated readers. Oops, there we go. Okay, so we're going to spend a little bit of time on compensation because the compensation sections of the 990, as I mentioned earlier, are scrutinized by the most in the 990 by far. And of course, that kind of makes sense. We're all curious about what a particular individual makes in compensation. And not only that curiosity, but you as an organization leader might want to look at your peer organization 990s to see if your compensation amounts and practices are in line with your peers so you don't lose your key people. If you're a donor, you might look at compensation to ensure that that compensation is reasonable reasonable in your opinion, and that your dollars that you may donate to that entity, in fact, gets spent on the programs rather than on the compensation for the people carrying out those programs. So there are two parts that report compensation information on the 990, and everyone has to fill out Part 7 in the core form. And for those individuals who make more than 150,000, the filing organization is required to include a Schedule J. Two important points about compensation reporting before we look to a few of the details. Again, we're not going to get in the ticky-tack kind of things, but we are going to look at it very broadly. And those two important points are, regardless of the organization's fiscal year, compensation is always reported on the 990 based on the calendar year. So if an organization has a calendar year as its tax period, there's no difference. So a 2023 return is going to show 2023 compensation. But what if the organization has a fiscal year ending, for example, June 30th of 2025? Well, the rule here is that the compensation is based on the calendar year that ends within that organization's fiscal year. So obviously, December 31st of 2024 ends within the June 30th of 25 tax return year, which of course that year would be from July 1st of 24 to June 30th of 25. So our compensation reporting in that particular case is based on 2024. So everyone's on the same basis, but this can lead, even for calendar year organizations, for that information on the 990 about compensation to be very old. Organizations have, the 990 is due within 4.5 months. So for calendar year organizations, that would be May 15th. An organization can request an extension of 6 months, taking all the way out to 10.5 months after year end, or November 15th for a calendar year organization. Then we have to allow some time for the IRS to process the return, to upload the data that it gives that it sells to GuideStar, ProPublica, and others. So that's probably another 3 to 6 months before an organization's 990 actually gets posted on the internet. And if your calendar year 2023, you filed an extension until November 15th of 2024, and maybe 6 months later, your 990 appears on GuideStar and May 15th of 25. A lot of time has passed since that 2023 information was put out there. And obviously, it's exacerbated if you're a fiscal year, because again, you're using the calendar year for that reporting. So with those two things in mind, let's go next to our who is required to be reported. And what I like to talk about here is thinking of this reporting structure as a hierarchy. And we're going to start at the top and we're going to make our way down the hierarchy. But in general, once a particular person meets the requirements of one of those steps, we stop and we don't go any further down in the hierarchy. The only time that we have the possibility of a person having two designations is if that person is an officer and also a voting member as a director or trustee. That is the only time where we will have two designations. And in Part 7, there are check boxes for the particular role that a person is deemed to be doing. And so there's only the possibility of two check marks for an officer who is also a voting member of the board. So when we start with directors and officers, we list all of those people and their compensation regardless of the amount. Now, many of your organizations, if not nearly all of them, do not compensate their directors and trustees. So, of course, compensation in those cases is zero. Once we get past the voting members of the directors and trustees, we next go to the officer level. And officers can be based on state law. They can be based on your organization's articles of incorporation and bylaws. And so really they're all over the place, essentially. And in some cases, an organization will not have any compensated employees that are designated as officers. So for example, the chair of the board could be the president. And rather than having the CEO be the president as an officer under the definition. And the IRS was wise to that, and they put in a rule that states that the following two people are officers for 990 purposes, regardless of what their titles are. And that would be the top administrative official, whether that person is called CEO, president, executive director, they're automatically an officer for 990 compensation reporting purposes. Similarly, the top financial officer is also an officer for 990 reporting purposes, whether she's called CFO, VP of Finance, Controller, whatever her title happens to be, she has to be reported on the 990, and there is no threshold for reporting of officers, whether that individual makes $1 or $10 million. If they're an officer, their compensation has to be reported on the 990. The next level in our hierarchy is key employees, and I promised I wasn't going to get overly technical, and I won't, but there are 3 requirements behind this, the most important of which is that the individual has to have reportable compensation, which I will define on the next slide, of at least $150,000. So somebody cannot be key if their compensation on their W-2, again, as we're going to look at more carefully in a minute, is not more than 150,000. Again, we won't go into those other 2 requirements, but again, that first one kicks a lot of people out of the key employee designation. Our final designation is our 5 highest paid non-officers, non-key employees, but only if those individuals have reportable compensation of over $100,000. Many organizations don't have any of these highest compensated because no one receives more than $100,000. But if they do, some people may be caught in this particular section of the hierarchy. There's also some very complicated rules with respect to when a former individual has to be reported. And a good example here would be in the college and university realm, where, for example, the president stops their regular duties, the existing president, as of July 1st of the new fiscal year, because most educational organizations have a June 30th year end. The new president comes in and takes over, but that former president is still compensated for the entire year. It may be a sabbatical, it may be for consulting purposes with the new president, but in that case, they are deemed to be reported under the rules as former. Again, it's a lot more complicated than that, and I don't want to get lost in those details, but sometimes you will see the former box on the Part 7 of the 990, and that is why.
Chris, I'm going to interrupt
Yes.
you quickly. There's one
Sure.
question. If we contract for a CFO, would this person or agency need to be listed?
So that might be a little bit more complicated question than the questioner actually asked, but I'll describe 2 scenarios where this becomes relevant. One is if there is a contract person and you're giving them a 1099, rather than for a firm, but they're just doing it in their individual capacity, then that 1099 is also deemed to be reportable compensation, like you can see on this slide here, even though we haven't gotten down to reportable compensation. But W-2 and the 1099 NEC would, those amounts for officers would have to be reported. The other instance in which you might have a contract CFO is if you're using, for lack of a better term, a management company, and there are specific rules with respect to the management company and what needs to be reported there. Very simply, and again, I would encourage the questioner to take a look at the instructions in the 990 with respect to this question, as well as have a very good discussion with their tax advisors about it to see if you meet the required reporting for the management company. But many times, the fact that there's a management company in between the organization, so to speak, and the person serving as a CFO does not relieve the organization of reporting that compensation on the 990. Again, it's a lot more complicated than that, but as a very high level answer, I think that's what I would say. Any other questions while we're on a brief pause?
Not at this time.
Okay, so now we know who's being reported, we're next going to turn our attention to what is reported. And as I had mentioned in my answer to that question, it's all about reportable compensation as our starting point, which is defined as box 5 of the Form W-2 or the amount on the 1099 NEC. And for the W-2, it's Medicare wages. And I like to call those, even though it's a bit redundant, gross wages. But that in and of itself is a bit of a misnomer too, because there is one deduction that will often come out of gross salary, and that is for the Section 125 pre-tax contributions that the employees make toward their health, dental and the like kind of insurance. Again, sorry for getting a little technical, but box 5 Medicare wages is not exactly gross, but it's one of the ones that is almost the gross wages. And so that is our starting point. So in part 7, there is a column just for the amount that's in box 5 for each person that's reportable on the 990. There's another column on part 7, which is entitled non-taxable benefits. And these non-taxable benefits include the sum of employer contributions to retirement plans. So whether it's a 401k or a 403b, this would be the matching contribution or the discretionary contribution made by the employer, but it will not include the employee's portion, their pre-tax contribution to the plan. And why is that? Because it's already in the Medicare wages in box 5. And to the extent that we are permitted, we obviously don't want to double count anything. So again, in the non-taxable benefits, the employer contribution to the retirement plan goes in, but the employee contribution is already in the reportable compensation box or column. Contributions to welfare plans by both the employer and employee are also included in non-taxable benefits. And again, not to get overly technical, but there's something out there called non-qualified deferred compensation plans under 457B and 457F that some more sophisticated organizations will offer to their key executives. And if there are any contributions to those plans, those also get aggregated in with the other non-taxable benefits. So if the filer has people that have compensation in total, that would be both the reportable compensation and that non-taxable benefit total that we just looked at. If that is more than 150,000, we go over to Schedule J, because that's a required schedule now for that filer. And in part 2, you can see this grid here where we break out those individual compensation amounts in a bit more detail. So our reportable compensation from our W-2 is broken down in column B between base, bonus and incentive, and other reportable compensation. Then our non-taxable benefits are broken out between columns C and D with the retirement and other deferred compensation. Again, keeping in mind for column C, it's just the employer contribution to the retirement plan. And then all of the other non-taxable benefits go in column D. That's part 2 of Schedule J. Part 1 has a number of questions on the page before part 2 with respect to various compensation issues that a filer might have. One of the most important is a checklist of comparability data used in setting the compensation for the top administrative official, the CEO, executive director. So there are checkboxes for things like compensation committee, independent compensation consultant, looking at 990s of other organizations, and things like that. There are also questions with respect to whether your organization paid out severance payments, and if it did, you have to identify the individuals and amounts. Same is true for any compensation, really incentive-based kind of compensation, that is contingent on certain revenue, net earnings, or other non-fixed payments. Again, those would have to be disclosed by person and by amount. And then Schedule J Part 1 starts off with a checkbox of questions as well with respect to indicating whether your organization offers any of these benefits to your employees, your key employer, your top employees. And one of my favorites on here is the very last one with respect to personal services, maid, chauffeur, and chef. I would like to have a job where I have a maid, chauffeur, and chef. But all kidding aside, the most common filer that will check this box would be a college or university, because they provide housing on campus for the president. So up actually right here in the housing payments at the top of this second column, we would be marking that because the president's house is provided to her by the college on campus. And she may host many dinners with alumni, donors, students, and the like. And for those dinners, perhaps someone from food services comes over, cooks the meals, and then there's housekeeping to clean up after those events. And so we would mark that personal service box. So it's not as bad, quote unquote, as you might think. So that really is our compensation information in a very high level. And again, because it's the most reviewed section of the 990, I did want to spend a significant amount of time on it. We're going to go to the other sections of the 990 in the time that we have left and start first with program service information. Going back to my comment earlier about the public relations nature of the 990, the program service sections of the 990 really offer the tax-exempt organization the ability to sell, quote unquote, its accomplishments and programs to the general public and show that the organization is indeed worthy of its tax-exempt status. I like to see lots of statistics here, particularly in the program service accomplishments for the 3 largest programs. And I have one client that's a private school below the college level. They literally give me 5 pages worth of information about things like the number of National Merit Scholars, the number of students who select their or who get into their first choice of college, what their athletic teams had won at the regional and state levels, and all really great information that would be on a public document for your prospective students, prospective donors, and the like to see. Also, program services, you are required to list if you have any new activities and have any existing programs that you have ceased conducting. And you can use Schedule O almost unlimited. There are some character limitations with respect to the softwares that are required to do 990s and to e-file the returns. But here, in general, the more information you can put about your program service, the much better you will be. Financial information almost takes a back seat in the 990, and except for the little mini income statement and balance sheet on page 1 of the 990, all of the detailed financial information is on the last 4 pages. So we have 4 sections, 1 for each revenue, expenses, balance sheet, and reconciliation of the change in net assets on the final 4 pages of the return. And in the expense section, this is where a lot of our watchdog organizations and so-called self-appointed watchdogs will look at the breakdown of expenses between program service, management in general, and fundraising, and determine, for example, well, this organization has only 70% of its total expenses spent on program services, and that's bad because they also have 25% spent on management in general, and that's way more than it should be. Now, there are organizations out there, as you probably know, like Charity Navigator, that do compare peer organizations to each other and use percentages like that. But in general, you have to be very careful with making sure that you are picking the categories very deliberately. Schedule D is for supplemental financial statements, a lot of balance sheet information, and then things for specific activities like donor advised funds, conservation easements, and the rest of the things that you can see on this particular slide. We're going to move quickly through grant recipients since we're almost out of time, where we have to list both domestic organizations and individual grants, as well as those in foreign countries. And then probably one of the more controversial sections is part 6 of the 990 that asks about governance and other policies that have absolutely nothing to do with an organization's tax-exempt status. In other words, the things that you see on this screen, including whistleblower and conflict policies that Jackie talked about earlier, those are not required by the Internal Revenue Code for a tax-exempt organization, but this is really the IRS's way of asking best practices questions on a public document like the 990. So in fact, there are quote unquote bad or wrong ways to answer these questions, and organizations should really think about why they don't have these policies if in fact they don't. We talked a little bit about activities in foreign countries, and on the part 1 of Schedule F, we do have to break them down into the categories we see here. And again, I apologize that I'm moving very quickly through here, but the final slide, and I want to leave a minute or so for questions, there are other areas that are scrutinized by sophisticated readers like me with respect to things like public charity status, lobbying and political activity, especially since we've just recently been through a big election cycle, tax-exempt bonds, transactions with insiders, and the like. And with that, I will wrap up and see if there are any questions.
Thank you, Chris. Right now, we do not have any in the chat area. If you do have a question, please feel free to type one in, and we'll give you a couple minutes. And if not, we'll just go ahead and close the webinar. Thank you all for attending.
Hey, Chris, I want to go back and emphasize something you've said, because I hear a lot of this from various nonprofits. Because the 990 asks if you have a conflict of interest or whistleblower, some of those policies you put up there, they assume they have to have one. And so I want to emphasize that you said, no, you don't. It's a great idea. You should, but the IRS does not require that, correct?
That's correct. None of those. So conflict, whistleblower, compensation review, document retention, those are all optional. But again, you have to consider the public relations aspect, especially on things like conflict of interest and compensation review. Why aren't you doing those things? Because
Mhm.
well-run and well-managed organizations have those policies.
And Chris, I also want to emphasize something else you said, because I had a nonprofit leader say to me recently that they were expanding out their program accomplishments and missions for their tax preparer. And their tax preparer said, you can't have that many pages of this.
Wow. Well, I did mention earlier that there are some character limitations in the software. And by the way, we're not allowed to attach PDFs of any extra details. But in general, even with that one client that I mentioned that gives me 5 pages, I have been able to get all of that text into our software. So you really shouldn't consider that, and no accountant should tell you that you have to cut back on what you want to tell the community about your organization.
And it can be a great marketing. I mean, it sounds kind of crazy, but if, to your point, if you really put some statistics and so forth, it can be a good marketing tool for you.
And for bigger organizations that have a development department, they will actually help with those program service narratives because they're on the front lines telling donors all of the wonderful things that they're doing. They help with the 990, and then they also point to the 990 as, hey, this is what we tell the IRS and everyone who looks at it. These are the wonderful things that we do, and you should give us money.
One quick question is, I don't know if you all are aware of this or know the answer, but it's, do most organizations house their 990s on their website?
So that is optional. A lot of organizations do. And by the way, when I was talking about those public inspection requirements, one of the things that is also required is that you have to give a copy of a 990 to somebody if they want it. You can be relieved of that obligation by giving them the website address on your website of that particular 990, but it is not a requirement. And by the way, just because your 990 is on GuideStar or ProPublica does not mean that you can claim that exemption. You have to do it personally on your own website.
Chris, can you put on your own website 990 available upon request?
You can, certainly, because again, you are not required to post that anywhere. You are required to have it in your business office for public inspection. But that is the extent of it. There is no requirement to post it on your website.
Another 990 question is, can we use a 990 that has donors redacted?
Yes, great question. So Schedule B is where we have donors, and we give all of our clients what we call the public inspection version of the 990. And under the public inspection rules, we are allowed to redact the donors' names and addresses on Schedule B. We cannot redact the amount of the contribution, but you can't tell who it's from. And there are sometimes non-cash descriptions on Schedule B that also have to remain. So that's why we use very generic language there, like publicly traded securities or closely held stocks. So we don't want to give the identity of the donor away. If you go to GuideStar and ProPublica, when the IRS gives the 990 data to those organizations, they remove Schedule B entirely. So you don't even get to see the amounts and the non-cash things that I just mentioned. So please make sure that you know, and especially use this as a donor tool, the identities of donors reported on Schedule B are protected. And actually, there's some cases out there that might remove Schedule B in their entirety because they're saying it's a First Amendment kind of thing. So as that works through the system, we may not have anybody having Schedule B anymore. We'll see what happens.
Okay, well, with that, I think we have answered all the questions that have been submitted. And we thank you all again for joining us today for this webinar. We will be sending the slide deck out to everyone who signed up for the seminar today. And there, we will also include a slide with Chris and Jackie's contact information in case you have a question that pops up that you forgot to ask. So thank you again, and that concludes our webinar today.